Ladies and gentlemen, it is my great pleasure on behalf of Insurance Laboratory Law and the Committee Management of AIDA Polska to welcome you to the conference titled State Intervention on the Insurance Market, Caring Guardian or Authoritarian Regulator. This event has been organized under the patronage of the Dean, the Faculty of Law and Administration, and support of the Dean, as well as the Financial Ombudsman and Ergo Hestia. In a moment, the Dean will deliver the official opening address. I would like to warmly welcome all representatives of the legal community involved in the insurance and financial market, as well as the students who have joined us today. It is a particular honor for us to host Professor Pierpaolo Marano. Thank you all for coming. I wish you an inspiring and fruitful conference. I now have the honor of inviting the Dean to open our conference.
Thank you, Professor Maśniak. On behalf of the community of the Faculty of Law and Administration, I would like you all welcome cordially here in Gdansk, in the Faculty of Law and Administration. I think the topic of this conference is crucial. We cannot overestimate the role of the state on the insurance in the insurance market, and the state is a very important factor. And I would like also to take this opportunity to say welcome to our distinguished guest, Professor Marano. You are welcome here. I would like to welcome you all to join our faculty, to visit our beautiful city. And I wish you nice staying in Gdansk. And of course, I wish you a fruitful deliberation today. Thank you. Welcome.
The first panel will be moderated by the Professor Katarzyna Malinowska from Kosmiński Academy. The floor is yours, Kasia.
Okay, hello everyone, good morning. That's my honor and pleasure to start the first panel and also start and to introduce the guests. I would like to introduce both our speakers for the first panel. Professor Pierpaolo Marano, I would like to say a few personal words. I don't know better Italian speaker than professor. I don't know many equally good speakers than Professor Pierpaolo Marano. And let me say personally that Professor is a real man of Renaissance, which comes as no surprise because Milano is the city where Leonardo spent several years. So if you plan a new topic, if you dream about new theme, let's check first if professor has not already been researching on that and consulting about it. I'm very happy also, and I think we will be having very fruitful discussion after the panel. My second speaker, let me introduce both of the speakers together that the panel goes smoother. The second speaker is Dr. Damian Cyman, the assistant professor at this university. Dr. Cyman specializes in financial markets, and I wanted to show a book. Yes, I just showed today a book of Dr. Cyman, The Protection of Unprofessional Participant of the Financial Market in Poland. I can show it to the camera so everyone can buy it and read it. And this is a very needed book on this market. Thank you for that, and I wish you very success as regards this book and your further plans. And finally, me, Katarzyna Malinowska, and I would like to remind the spirit of our colleague Mariusz Fras. Let Mariusz's spirit be with us today during our discussion, during our dreams about the perfect insurance market, perfect insurable society, having no gaps, being prevented from all the risks. And yes, with that word I would like to start. And Professor Marano, your speech, The Return of the State in European Insurance Law. Please take floor.
So, good morning, distinguished colleagues, ladies and gentlemen. It's a real pleasure and honor to be here today at the University of Gdańsk. And I would like to begin by sincerely thanking the organizing Dorota for this invitation and for the opportunity to contribute to today's discussion. The title of my intervention, as Katarzyna mentioned, is The Return of the State in European Insurance Law. The expression is intentionally strong. Indeed, it's meant to provoke a question. Has the state really returned? Or perhaps more precisely, did it ever truly leave? So for several decades, the dominant narrative in European insurance law has been one of market integration, liberalization, competition, and supervisory convergence. The legal vocabulary of our sector was shaped by notions such as freedom of establishment, freedom to provide services, home state control, passporting, regulatory harmonization. The underlying assumption was clear. Insurance market, once integrated at the European level, would be capable of delivering efficiency, innovation, and consumer welfare through competition. In this narrative, the role of the state appeared progressively reduced. The market, rather than the public intervention, became the principal organizing principle. However, I would suggest that the current evolution of European insurance law tells us a different story. My argument today is that we are witnessing a profound reconfiguration of a public authority in insurance regulation. The state is returning, but is not returning in its traditional 20th century form. This is not the return of a direct price control, administrative paternalism, or purely national intervention. Rather, the state intervention is emerging as a new European public authority, one that operates through a multi-level regulatory framework. To be clear, when I make reference to European public authority, I'm not making reference to an authority in a legal sense, but in a multi-level system where there is a IOPA who is playing a central role of coordination together with the national supervisory authorities. This return, in my opinion, can be observed mainly through three axes. First, the state as a market corrector. Second, the state as a systemic stabilizer. Third, the state as a technological governor. So let me address briefly these three axes. So let me start with the conduct regulation. If we look at the evolution of European insurance law over the past decades, one element becomes immediately apparent. The focus is no longer simply on ensuring that the market functions formally. The concern is increasingly whether the market produces acceptable substantive outcomes. This is a crucial shift in the state intervention. Traditionally, European regulation relied heavily on disclosure-based mechanisms. The paradigm was the one of the informed consumer. If the consumer will receive the proper information, the consumer is in the best position to take the appropriate decisions. Perhaps this is excellent from a theoretical point of view, but doesn't work in practice. So, the growing reliance on product oversight and governance and the emphasis on value for money suggests us a different perspective. And which is this different perspective? Is that the regulator, the legislator, is no longer satisfied with the traditional paradigm of transparency / inform the consumer / the optimal solution. The regulator asks a more intrusive question. Does this product actually deliver value for policyholders? Because if we look at the product oversight and governance, this is the question regulators are asking to insurers, or I would say manufacturers. Can you please demonstrate that this product you are designing is embedding value for policyholders? So, if we want to approach from a legal perspective, this is in essence a public law assessment of the economic substance of private contracts. And so this reflects a significant normative development. Public authorities no longer limit themselves to protecting freedom of choice. They scrutinize the fairness of outcomes. This is why I describe as the return of the state. The state reappears as a market corrector, intervening not only in the rules of exchange, the exchange between the parties, distributors and customers, but in the substantive architecture of insurance products. The supervisory discourse has progressively moved toward product quality, pricing coherence, governance accountability, and customer outcomes. In other words, the market is no longer presumed to self-correcting. Public intervention re-enters the scene to correct distortion that competition alone may not resolve. So, the second dimension concerns financial stability. For many years, insurance was often considered less systematically relevant than banking. The debate on systemic risk was largely dominated by banks, central banks, and resolution frameworks designed for credit institutions. Insurance was often treated as different, and to some extent was correct. The business model differs, the risk structure differs, the contagion mechanisms differ. However, there is always however, this distinction should not lead us to underestimate the public significance of insurance failures. Recent developments, particularly the evolution of Solvency II framework and the emergence of recovery and resolution mechanisms under the Insurance Recovery and Resolution Directive, clearly indicate a change in perspective. The failure of an insurance undertaking is no longer regarded merely as a private contractual problem. It is increasingly understood as a matter of market confidence, cross-border stability, consumer trust, long-term savings protection. This is particularly evident in life insurance. We have experienced recent failures in life insurance. One, which was related to FW, was related to a Luxembourg-based life insurer owned by a German holding carrying out business mainly in Italy. The second one was related to an Italian insurer, life insurer, who distributed life insurance coverages through a network of 26 banks. So, the protection of accumulated savings, pensions expectations, and long-term household wealth inevitably raises broader social and economic concerns. Can you imagine? I make reference to these two failures. More than 300,000 Italian policyholders bought life insurance from two insurers, and they are in a crisis. From a political point of view, what do you think? The state can say the market can do what they want, or perhaps these policyholders / voters are relevant. Just to mention, after the crisis, we have introduced a guarantee scheme for life insurance. This was, the fast reaction. So the state, in other words, returns in a classical, however, modernized function. The state is a guarantor of stability. The logic is no longer merely reactive. The intervention is increasingly preventive. This is the essence of contemporary prudential law. Has Solvency II introduced a forward-looking approach, which means that I don't have to wait to be in a crisis position, but I have to predict my liabilities, and I have to predict if I have assets corresponding to these liabilities in a forward-looking approach. The same is strongly requested now under the Insurance Recovery and Resolution Directive, because we have already in a Solvency II framework preventive measures, but then they are reinforced under the Insurance Recovery and Resolution. So we pretend insurers, on an ongoing basis, they have to update their recovery mechanisms. At the end, the state no longer waits for collapse, it builds resilience in advance. This is why the recent reforms of the update of Solvency II, the review of Solvency II, and above all the adoption of the Insurance Recovery and Resolution Directive are significant. They reflect a broader shift from supervision as compliance to supervision as resilience. And the resilience is ultimately a public good. The third dimension is perhaps the most fascinating. Technology is fundamentally reshaping the insurance sector. So, we have artificial intelligence, algorithm underwriting, predictive analytics, automated claims management, digital distribution platforms. All of them are transforming the insurance industry. Insurance decisions are increasingly produced by systems rather than individuals. And what this happens, regulation must follow. This is where the return of the state becomes especially visible. The adoption of the Digital Operational Resilience Act and the broader framework introduced by the European Union Artificial Intelligence Act illustrates a remarkable development. The objective of regulation is no longer only the insurance contract. It is now the technological infrastructures behind this contract. This is a major conceptual transformation. Traditionally, insurance law focused on rights and obligations between parties. Now, regulation increasingly governs algorithms, datasets, governance systems, operational resilience, explainability requirements. In other words, the state returns as governor of technological risk allocation systems. If the decision depends on a black box, depends on an algorithm, but we cannot have a full awareness on how the algorithm functions, at the end, the decision lies on a black box. Governing the black box, it means governing the allocation of liabilities, allocation of decision, in other words, regulating the obligations between the parties. This area is increasingly relevant also from an internal point of insurance undertakings, because it requests the system of internal control and the operational units to explain how the algorithm is working, the logic behind these algorithms, and at the end, it requests to explain the governance of the decision-making system. But also in terms of litigation, this is an interesting perspective, because it's requesting lawyers to questioning how the decision has been taken by this automated system. In other words, to ask for the documentation demonstrating that this decision-making process is complying with the law. Not only the sectoral law, insurance, but also the wider law, the broader law, Artificial Intelligence Act, and I would say the Charter of the Fundamental Rights of the European Union, which are expressly mentioned in the Artificial Intelligence Act. So, at the end, if the state is the governor of technological risk allocation systems, we are not in front of insurance law in a classic sense. It's insurance law intersecting with the digital regulation, platform governance, and artificial intelligence supervision. For someone working in our field, this is perhaps one of the most intellectual significant development of the present time. I don't want to abuse of your patience, and I go to my final reflections. So, the final reflection is that the state intervention puts us in front of a new form of statehood. So when we speak of the return of the state, we should not think nostalgically. This is not the return of the old state. It's the emergence of a new form of European, let's say, public authority in a broader sense. A state that acts through principles, supervisory expectations, soft law, governance requirements, resilience, obligations. This is a state that does not replace the market. I want to underline this. Rather, it shapes the conditions under which the market may legitimately function. And this is, I believe, is the key point. Insurance is not merely a private business, it's a social institution of trust. Why? Because it allocates risk across time, across individuals, across society. Whenever trust, long-term savings, and systemic reliance are at stake, public authority inevitably returns. That's, in my view, exactly what we are witnessing today in European insurance law. Thank you for your attention.
Ladies and gentlemen, I'd like to explore how insights from behavioral economics can be applied to insurance markets, particularly through the concept of nudging, a subtle yet powerful way of shaping decisions without restricting individual freedom. Insurance markets are a fascinating context for studying human behavior and human decision-making. In theory, individuals are expected to make rational choices. As we can see here, the concept of Homo economicus was very popular for a long period of time. So we are supposed to evaluate risk, to compare policies, and select the option that maximize their expected utility. However, studies mainly done by Daniel Kahneman and Amos Tversky, two psychologists, demonstrated that individuals frequently rely on heuristics. That means mental shortcuts that simplify decision-making under uncertainty. They're very easy to take, they are very easy to use in our life, but they have some disadvantages, like they can lead to systematic biases and errors and often deviate from rational decision-making. In his book, Daniel Kahneman presented two systems that we have in our minds while making decisions. A system one that is very simple, very easy, very fast, that we used in very simple tasks. And the second system, system number two, that is much more complicated, that requires deep thinking. And because of that is more costly for our brain and for our cognitive abilities. So if we have an easy task, an easy question, then we use this system number one very fast. So like in this example, if we have a question, a bat and a ball cost $1.10 in total, and the bat costs $1 more than the ball, then our brain automatically make very easy calculations. So $1.1 minus 1 is 10 cents. So the answer is very easy. The ball costs 10 cents. And that's how we use the system number one. But decisions or human behavior tends to be boundedly rational. So it's not only about logical calculation. There are also cognitive limitations. So there is sometimes so many informations that we cannot proceed and we cannot calculate what is the consequence of those informations. So that's why education and financial literacy is so important. There are emotions. So very often decisions are made by our emotional thinking, not only by logic. And contextual factors. So every decision is made in some context. And in this context, or this context is very important to choice architecture. Yeah, but before we go to choice architecture, let's go back to this example. The answer that the ball costs 10 cents is not correct. Because if the bat costs $1 and the ball 10 cents, then the difference will be only 90 cents. So unfortunately, and that's what we usually do, the system number one very often gives us wrong answers. The right answer is 5 cents. So that's the example that sometimes we don't see the correct answer because of that. Choice architecture refers to the design of environment in which individuals make decisions influencing how options are perceived and selected. And it is obligatory because every design influences decision making. Here's a picture of nudge. The concept of nudging, it was popularized by Richard Thaler and Cass Sustein. That's the cover of the book that was written by them. So you can see 2 elephants here. If you have ever seen a herd of elephants in Africa, then you could have noticed with what care, but also with what determination the mother nudges her baby. From one side to discover this world, this exciting financial market, but from the other side protects it from predators, like some financial institutions maybe, and some toxic agreements. And there are some nudges that can be made by government or by regulator. So default options, those are options that are pre-selected for consumers, and they are not obligatory. We can change them anytime we want, but they influence deeply for the market. For example, we could compare 2 options like in New Jersey and Pennsylvania. They had the same insurance, but in New Jersey, the default option was limited compensation, and full compensation was only with additional payment. But in Pennsylvania, the full compensation was default option, and limited compensation was offered with a discount. And what was the difference? As you can see here, less than 20% of consumers in New Jersey choose full insurance. And in Pennsylvania, it was about 75%. And the difference in income and in spending was $200 million. And that was only because of default option. The second thing, the second tool that we can have is simplification and standardization. By standardizing key elements and presenting information in a clear, comparable format, policymakers can reduce cognitive overload and improve decision quality, because agreements are often too complicated for consumers, for ordinary consumers, but also for lawyers. For me, they are too complicated. So, if we have those key informations in insurance products, then it makes it quite easy to compare some products, some different options, and to choose the best one. Another thing is framing. The framing is the way that choices are presented. So, if we emphasize potential losses from being uninsured, tends to be more effective than highlighting gains from being insured. And we react to this framing. For example, if we have, let's imagine that we have 2 sessions in an hour, and if I inform you that on session A, 90% of talks are interesting, and on session B, 10% of talks are boring, then almost everyone would choose session number 1. But the information is the same, so it doesn't differ any way. But the way that we present makes difference. Timely prompts and reminders. So sending reminders at critical moments can counteract procrastination and inattention, sometimes laziness maybe. So like car insurance renewal reminder, if we receive a reminder and we do it, if we have a car insurance and with a direct renewal link, a summary of current coverage, and a prompt to review or adjust the policy, then our procrastination is limited and we can overwork it. So, to answer the question that we had on the beginning, the title of this conference, the state should be neither a gentle guardian nor an authoritarian regulator, but a smart guardian. It should be soft, where consumers can still choose well, but where market structures make exploitation likely, then regulations should be hard and strict. Thank you.
Okay, good morning again. My topic for today is who prevents the loss? And it's about recognizing prevention as a function of insurance distribution. And one may ask what I'm doing here when we are discussing the role of the regulator as a guardian. What's the purpose of my speech within that context? I want, to say it explicitly, I want the state to appear, not to return, but to appear finally in whatever role, in the role of guardian, in the role of tender tutor or mentor, or intervening in the form of a hard law, in whatever role that would enhance the loss prevention. I think it's high time, and I must admit that I feel sometimes like a Don Quixote fighting for this prevention recognition in our legal system. Though also I found some Dulcinea recent years, and I'm looking at my Dulcinea. Professor Fuchs is one of my Dulcinea for Don Quixote to help and to assist in fighting for prevention. So I feel somehow that my speech today complements the statements of my colleagues because I also see everyone sees insurance as a social institution. It's not a private business, not at all. Today, in this current landscape of risk, emerging risks, and also I see lots of potential in legal nudging of the insured, stimulating by, even if not by regulatory hard framework, then by very competent distributor. So my question is who does the loss prevention in today's insurance market? And quick run, where is prevention in the current legal framework? Is it in IDD? Is it in the Polish Insurance Code? Is it in product oversight and governance regulations? Maybe it results from the general duty of care, good faith, utmost good faith. And I will stop for a moment in the insurance distribution law because it's more recent, much more relevant than Polish and even not Polish, European insurance codes and laws, insurance contracts codes and laws. I may say that the insurance distribution is more relevant. And let us look at, for example, demands and needs test. IDD requires distributor to act in the client's best interest. Can we extend this to advising on risk reduction, on loss prevention? The text itself is silent, but its purpose is not. When you look for value for money, EIOPA and Polish regulators, product value must include tangible benefit. Are prevention-related services such tangible benefit or still not? Product oversight. Insurers, we know, must design product meeting identifying needs. If our target market, so the addresses of the future policyholders, face losses that are preventable, do we have to embed these prevention services, this prevention potential into the product? And finally, the insurance distributor, is he liable for not advising on possible and achievable prevention? I think we have a bit of a blind spot here. Distribution, as it's currently understood, there is a transfer of risk. So preparatory activities where after which the risk is transferred, premium for coverage. We have the information advice obligation, conflict of interest management, suitability and demands and needs, product oversight. And when we look at prevention, it's not included in the definition of insurance distribution. It's not recognized as the distributor's duty. It's absent from the IDD framework, we can see. It's also invisible in remuneration structures, so not even discussing the liability framework. So if we even feel that distributions are functionally qualified, competent to promote prevention, the law, especially IDD, does not say a word about it. I will show for a moment a slide which I've shown several times already, but it helps me because this is a slide once shown by Polish supervisory authority at the Brokers' Congress when they defined the comprehensive brokerage service. And on this list, what we see, risk quantification and optimization. We also see advice on the right selection of security. Isn't it prevention? Well, is it such a burden for the distributors to become the guardians of prevention or the mentors of prevention? Not at all. I will not develop much on that, but if we look how the technology looks like, Professor Marano mentioned it in few words as well. We have artificial intelligence, we have predictive analytics, the real-time management of disasters, satellite observation, which really helps minimizing the losses, Internet of Things, telematics, where we have already very tangible studies how they can reduce the loss. So there are possibilities, there are no rules. So maybe let's go to some natural competencies of the distributors, as I've tried to be relevant to Dr. Simon's speech. The distributor can be a natural architect of prevention. He can overcome or help overcoming the behavioral barriers of the clients. For example, his optimism bias. The insured usually underestimate their own risk. Prevention costs now, so that's the perception. The status quo, it always has been so and it helped, so why not for the future as regards the risk reductions tools, and of course information overload. So these are the biases that good distributor can fight with, and use some behavioral toolkits. So advice on prevention rather as a natural part of the insurance scheme, advising on some surveys or audits, comparing with some other clients, etc. Lots of behavioral tools there are. Also, we, however, have to have in mind that the distributor can face also a dilemma based on his preferences, because there are market incentives that act against prevention. Higher risk means higher premium, higher commission. Where there are more losses, the people are more keen to insure, and where there is a claims handling, there is another possibility to touch the client, to enhance him to buy more. And there is no legal duty to advise on prevention, and of course preventions are costs, and costs of education of the distributor, etc. But there are also some market incentives for prevention, so the agent broker can be on the bright side of the moon as well. Long-term client retention, reputational differences in this very competitive market. There can be, and there are some attempts in the world to introduce prevention-linked remuneration based on telematics use, risk scoring, etc. And of course some ESG credential, some points in financing, in insuring for lower price and better coverage. So when we think about the models for recognizing prevention, we need everything. We need regulatory mandates. So we need finally explicit prevention standard in IDD. Of course, we can fight for it during next several years, but having such a regulatory incentive would be probably quicker, and we really need it quicker. There is already market incentive because the new technologies give such an incentive, we need also a behavioral design for which the role of the distributor is not to be underestimated. Coming to an end, I have, of course, some proposals de lege ferenda to expand and demand and need standards, if not by hard law, then by guidelines of EIOPA or national regulators, to set some incentives on prevention-linked remuneration for the distributors, describe value for money in the prevention context, and maybe also something related to liability for prevention advisory omission for the distributors. I know that sounds harsh. So finally, who prevents the loss? The state must prevent the loss, the distributor must prevent the loss, and obviously the insured must prevent the loss. And the final word is that prevention is absolutely not peripheral in insurance distribution. It must be one of its recognized. It is, but it must be recognized as one of its core functions. Thank you. So we now come to the discussion. We still hopefully have some time because my speakers in my panel were very disciplined. So now we have such an excellent audience. I would encourage you to ask questions, to question what we've said, and there are our splendid colleagues with microphone waiting for the first questions. Yes, Professor.
Marcin Kawinski, Warsaw School of Economics. Unfortunately, I haven't heard what Pierpaolo said, so I won't ask the question. But concerning the prevention, if you look what is happening within at least the EIOPA, is to build capacity among insurance companies. And at the end of the day, this is insurance company that knows to what extent particular prevention is good or not. Because we could have a lot of prevention that is not clearly so effective as the others. So that's why when I think about the prevention, the first role really is for the insurance entities. Then within product oversight and governance, there should be some hints in what kind of prevention is generally good in particular situation. And then we could expect from distributor to have in mind these prevention measures. Of course, we've got brokers, but brokers are minority of the distribution market. And in most cases, we have to really say the distributor or to provide clear guidance. Okay, in this case, you offer this kind of prevention, in that, this kind of prevention. But these guidelines must come from insurance company rather than distributor itself. So I think, I know it doesn't make the things more simple, but in my opinion, it's slightly more complex, and we start from insurance company and Solvency II really measures, and it's happening really, because sometimes you cannot offer the insurance product without prevention. So it's happening due to like natural catastrophes. and climate risk. It's just happening. But then we need to move this with product oversight and governance regulation to the product itself. So this prevention must be possible within the product. It must be part of the product. And then we could expect from the distributors to offer this prevention or not. So sorry, it wasn't really like the question, but rather the statement.
That was a comment. When I was talking about the distributors, I meant as well in insurance companies, because otherwise the product governance and value for money would have limited scope. But Marcin, I must say that you are my Dulcinea as well, because I called myself a Don Quixote about prevention, and I'm looking at Dulcineas, not Sancho Panzas, because it's not about assisting, but it's about the really understanding each other when talking about it. I've read a text some time ago that there are possibilities, there are frames, but nobody cares. You say that some really cares, but is it the implicit, and I would ask this question to Pierpaolo, is it such a implicit recognition of prevention or whatever value really we care in insurance is sufficient, or we need the regulator to be more conclusive about it? That we have the value for money, we have the POG, but is it sufficient to... is it under the supervisory measure? If it's not, is an insurance distributor supervised as regards prevention, for example? Or anything which is not in hard law? If not, then where is the obligation? We will wait probably for next 10 or 20 years. Do we have such time? Professor, what do you think about...
So we mentioned prevention, but my question is prevention from what? Because we have risk prevention, event prevention, loss prevention. So we need to be clear, okay? Loss, if the approach is loss prevention, I would say that this concept cannot be applicable to, let's say, nothing. Because first, in case of insurance-based investment products, if you invest, you always bear the investment risk, except there is an obligation from the insurer to guarantee the capital invested, perhaps a minimum return on your investment. But apart from this obligation, if you invest in products without this protection, this guarantee, you are exposed to financial losses. But this is inherent to the investment. We cannot eliminate this. The current regulatory framework is already in line with this prevention in terms of requesting first, in terms of product oversight and governance, that you have not only a positive target market, but also a negative target market. So you need to exclude that a number of potential customers can buy this product because you have already assessed that this product is not good for them. So in other words, they are too much exposed to the risk of financial losses. That is better they don't buy this product. This is already in the regulation. In non-life insurance, which is the most challenging part, because, you know, we always approach, or at least because of the MiFIDization of the insurance regulation, so we tend to approach insurance based on paradigms elaborated in financial services. But this can be acceptable if we look at the insurance-based investment products. It's very questionable if we look at the non-life insurance. In the case of non-life insurance, loss prevention, the question is, if I have a heart attack, I have a heart attack. So first, the loss will arise. The question will be how to inform you to prevent the event. So, let's say, with the bracelets, I will send you a number of messages in order to tell you, look, you are eating too much, you are sitting too much, and so drinking too much. I don't know, a number of requests. The question is, if we are under a contractual obligation, okay? Because I am sending you these messages, but you, as a policyholder, don't do anything, I'm liable as an insurer, I'm liable as a distributor. I don't think so. Because I send you the correct message, but you didn't care. So, in other words, we still have, for instance, black boxes in motor third-party liability insurance. Black boxes can be approached as, let's say, a tool to identify who is guilty in an accident, okay? This is a limited application, but I can also use this in order to send the messages to the driver to tell him, look, perhaps, you know, you are a bit, let's say, unsafe driver, even though we are lucky nothing happened. However, based on what I have to tell you that you are a bit unsafe. So, once again, I can be under this contractual obligation. I can send you the message. And then, if you do not comply, what happens? Then, risk prevention. But the risk prevention is different. If I use materials which are fireproof, I prevented the risk of fire. And this is already in place in the insurance sector, because when they ask you in the demand and needs test, they ask you, do you want to protect your property? Yes. And your property is a house? Yes. Please tell me a number of information related to your house. Wood or steel, I don't know. And do you have fire alarm? Which kind of prevention? This is already in place. So that's the reason why if we want to introduce a rule, perhaps, in my opinion, is good, but we need to be clear on what we want to prevent. The former president of EIOPA said that risk prevention will be the future of insurance. Risk prevention will transform insurance from a last remedy payer into a risk manager. However, the question is when this will happen. The answer is when insurers will understand the business model. Because if the insurers will be transformed into risk managers, because at the end this is the idea, they cannot do this for free. Because risk management, especially if it's under a contractual obligation, especially if it's under a legal obligation, means that insurers must organize themselves to do this. But if you organize yourself, you are affording costs. And if you afford costs, then you need to find profits. So the question is, can we transform the insurance as a risk manager, including the payment in case nothing, we were, let's say, unlikely, we suffered the event/loss. They are thinking about this, but in practice, if I ask customers, do you want to pay an additional premium to have me as a risk manager? Perhaps customers, they don't. If they are large customers, they tell me, look, we have already in place risk managers and they are managing these risks. That's the problem, is not related to the large customers, But the question is related to the mass market. But I'm pretty sure that if customers are always trying to to spend €1 less without looking at the contents of the coverage, because unfortunately comparison websites, especially the old style, they compare the prices without comparing coverages, which means comparing nothing, okay? But if customers, the case of comparison websites is I would say, is significant, because we have the clear demonstration that customers are looking for the lower price without looking at the contents, even though in non-life insurance, contents are determining, in general, the price. So, if this is the situation, are we sure that the mass market is available to pay for the risk management? In addition, be careful, be careful. In life insurance, in certain jurisdictions, if banks wants to get access to the inducements, they must provide advice on an ongoing basis. This is, for instance, the case of Italy. So, which means that banks are already a legal obligation to provide an advice to their customers to assess on an ongoing basis if the asset allocation is the optimal compared to the demand and needs of the test. In life insurance, this is feasible. Can you imagine in non-life insurance this kind of obligation? You understand that this obligation is challenging, because it means that if you are the owner of a factory, I need someone who has to come to make an inspection to your factory, because otherwise, where is the risk prevention? So it means that periodically, someone from, let's say, Warsaw has to fly to Gdańsk in order to make an inspection, in order to understand if you made some change. This is an educational room. If this became a repository of all our thesis, paper-based thesis, I think the risk is changing, right? So can you imagine a factory where they change everything without informing the insurer? If we want to prevent, someone has to be there and has to tell you, do this, avoid that. How much does it cost? That's the problem we have. Of course, now we have a number of, let's say, artificial intelligence tools rather than technologies that can reduce this cost, because, for instance, with a drone or with a satellite, they can have a clear picture of your factory and they can identify something. But the access to this system is not for free. I don't think Elon Musk is doing this for free. So, which means that this is an additional cost which must correspond to an additional business model. If someone is advanced enough to introduce this business model, we will have risk management plus insurance, rather than insurance at all.
Yeah, thank you. By this occasion, we don't have to worry about Elon Musk, because European Union, with its splendid Copernicus program, offers it for free, all the data on Earth observation. So, and insurers start to use them. And but I want to turn to the mass market, because this is really a problem, and that's something I would like to hear your opinion. Because can we allow that under the changed circumstances, the mass market, the consumers, are really treated still like sheep than just can do nothing, and they are forgiven because we have very pro-consumer regulation on insurance contract. And really, if you look at the some obligations of of the insured, especially in Poland or other continental countries, enforcing their prevention duties can be really a challenge. It's a bit different under UK law or other Anglo-Saxon, but in Poland, France, Germany, it can, I don't know, Italy, can be similarly difficult. And so that's my question for you. Are we ready for it, or should we just forget and focus on value for money, POG, so the changing the market by changing the distributors and not by the recipients. Can we change the target market behavior? And maybe some comment about it would be offered by Dr. Zyman. What do you see some chances in these circumstances? I'm sorry that I hope the prevention does not dominate this discussion, but it's just an example, because there are plenty of other aspects where we see that the distributors are under pressure, regulatory pressure. The big market, large companies are already aware. The medium and small enterprise really need it and start to become aware. And mass market, how to change their behavioral patterns?
Thank you for this question. So actually, to answer this question, we need to ask a deeper question about the approach of the government, whether it should be more paternalistic or more libertarian approach, and how much of freedom may be offered to financial institutions, what kind of products they can have, and what is the real meaning of the maxim voluntas non fit in iuria. So the first question is about axiology. And the answer for this question is crucial for further discussion. And on financial market, I would agree with Professor Orlicki in one of his articles. There was that on insurance market, there is no consumer protection, but it's much wider. So almost every insured is protected by law. And I think that they are changing, and financial market and insurance market have to be prepared for difference in, for example, calculating income. Before it was more about statistic. Right now, there are individual calculations. So, for example, if you want to have more and more often, if you want to have insurance of a car insurance, then the offer is compared to our driving behavior for other things. And like with this example, if you want a life insurance, maybe in the future there will be some bracelets, and with these bracelets we can have some discount if we behave healthy. There is a book, Artificial Intelligence 2041, and the first chapter about the visions for future is just about insurance market and about family in India and a teenager who wanted to date with a boy, and the whole family prevented her from dating this boy because it would affect the insurance for all family, only because this boy was not appropriate by this artificial intelligence. So the offers would be much more personalized. And so there are those two questions about values, about approach, paternalistic or libertarian, and about artificial intelligence and personal predictions of behavior of insurers. And we are on the beginning of this road. How it will be in the future, I don't know. How should it be in the future? I don't know. That's why this discussion is So I will be happy to learn your opinion about that. Well, actually, I am more for libertarian approach. So for me, the freedom is the most important thing that we have in our life. But still, some protection is very important, and protection from some toxic agreements is crucial for economy and for individual lives as well. So, thank you.
I want to address, first of all, Mr. Marano, Professor Marano's speech. You told that the state is intervening not only in the insurance market, but also the bank. So hopefully, so far. Once again, it's not working. Right. Maybe now. Oh yes. Now you can hear myself. So you were talking that the state is intervening not only the insurance market but also the bank market, which is obvious, and to some extent this intervention is not exactly the same, which of course is also understandable because each market, each sphere has its own characteristics. But in Poland, for example, we have a strange situation, maybe not now because it's weekend, but from the early beginning, when we were talking about the imposing the unfair contract terms, the protection, when we talk about the insurance, it was said that natural person will be treated like the entrepreneur, like the consumer, even if he is the entrepreneur. Yeah, we do not have such a regulation when we talk about the banks. It a bit changed in 2021 because the legislator decided that generally every natural person, entrepreneur who is concluding the contract, which is not completely connected with his professional activity, it is not his professional activity, he will be still protected. So that's why this difference a bit weakened, but still there is such a difference. And for example, in all those cases with the frank credits, it may be seen. Everybody may be treated like a consumer. And of course, another way of protection is a protection of a client, which is a bit different approach because we have to inform client about everything. We have to make the demand and needs test and so on. And it refers to all the clients, not only the consumers. And now my two questions to you, and maybe to everybody, how do you think, to what extent the banks and the insurers should be treated exactly equally, or how this approach should differ? And the second thing, this question of consumer protection and client protections, those two channels, independent to some extent, maybe they should be unified. What's the idea behind these two, to some extent, independent ways of protection? Maybe we should integrate it somehow.
So the question you raise is, let's say, a general question of European Union law, because we have sectoral legislation which is specifically addressed to insurance. Then we have, let's say, a bit larger sectoral legislation which is addressed to financial services. And then we have the horizontal regulation which is addressed to all the sectors. Consumer law in the European Union is horizontal regulation. So, which means that this horizontal regulation will include the insurance sector, but it is a specific niche of insurance sector, which means the relationship between distributors, insurers, and consumers within the customers, and with regard to specific areas, those covered under this horizontal approach. Insurance law, sectoral legislation, does not make this distinction. The distinction under the insurance law are different. Insurance law, first of all, approached policyholders, regardless if they are consumers or not. Then there are exclusions, and the exclusions are related to customers for large risks, one hand, or customers as institutional investors on the other hand. Life, non-life, life. If you are a bank and if you are investing in insurance-based investment products, you are not protected. If you are, let's say, the railway company in Poland, you are not protected because you are doing different job. So, which means that the approach on insurance is clear. Unfortunately, sometimes happens that in the IDD, for instance, you find the word consumer. And when you ask why the word consumer, it's because, I will be surprised to know, but many people also at the European legislative level make confusion between consumer and customer. This is the reality. So for them, they are interchangeable, especially at political level, even though from a legal point of view, it's clear the distinction between these two. In the IDD, in one of the recitals, you find the name consumer. And if you look at the previous draft, consumer appeared several times. But at the end, the situation is they are customers. However, once again, we have the in-between sectoral specific insurance regulation and, on the other hand, the horizontal regulation. We have the regulation on financial services. We have a directive on the distance selling of financial services, and they use the word consumer. So, which means that they want to protect a specific area within the customers. So, at the end, the situation is insurance must protect policyholders because a recital of Solvency II expressly mentioned that the main goal of insurance supervision and regulation in the European Union is the protection of policyholders and other beneficiaries of insurance benefits. And the word policyholder includes everybody. If we want to specify the level of protection, Pro Oversight and Governance is telling us that we can embed the protection within the design process of the products. So when you have in mind a target market, then you have to demonstrate to yourself as a manufacturer and to the supervisory authority that you have a clear picture of interests and needs you want to protect, and behind all of this and around of them, you are building your product. The question then will be how to transfer this analysis to the distributors, because at the end, distributors, they have to make, in practice, this selection. But in legal terms, in my opinion, is quite clear. Unfortunately, in terms of political perception, they are extremely interchangeable. And because of that, sometimes there is a bit confusion.
Professor Kawiński.
Just one more thing. When there was a MiFID directive, there was some work on this. There was a question whether there should be investor or consumer. It was the same discussion. Finally, investor was stated for many different reasons, but at least at the European Commission, they are aware of difference. What is happening in the European Parliament is a different story, but at the European Commission, they are aware of the difference, but when it comes to consumer, all right, but which definition of consumer should we apply? Yes, within the European legislation, it's much more complex because you can find in different places a lot of different definitions. So, which consumer do we mean?
But if I can add something, there is an interesting perspective. Because based on your question, you are thinking about, the extension of consumer to customers, okay? But perhaps we have the opposite. I give you an example. So we have the directive of unfair commercial practices. And this directive is firmly rounded around the average consumer, okay? However, this directive allows to introduce stricter definitions. So, for instance, just to mention, in Italy, we extended this in specific cases. So we have a different definition of consumer with reference to this one. But if we are in front of Proud Oversight and Governance, which is asking me to identify a target market. And the target market includes both consumers and customers. What can I do? I will make a selective application of the same behavior because of this product is combining both. And then the average consumer. Who is the average consumer when I make reference to the target market? I need to make reference to the target market in order to identify the average consumer. So at the end, perhaps we have an extension of strictly, let's say, dedicated horizontal regulations, such as the Unfair Commercial Practice Directive, to let's say, all customers rather than consumers. And it's interesting to say that the Artificial Intelligence Act does not make any distinction between customers and consumers. They are just telling us that if there is high risk, and the high risk is related to the contrast at the end with the human rights evaluation, then you can use, but you need to comply with the huge number of prescriptions which are, now introduced for high-risk systems, even though all of these prescriptions are already embedded in the insurance regulation. So for insurers, there is no novelty except this assessment in terms of at the end, knowledge of the European Chart of Human Rights. And then you have to make this assessment for yourself, or if you buy these systems, you have to check if the developers of these systems, they did it. So at the end, the Artificial Intelligence Act, who is classifying the artificial intelligence tools based on their impact on human rights, rather than technology. So at the end, it does not make this distinction. Perhaps the question is still valid a distinction between customers and consumers? That is more theoretical. At the beginning, we want to uniform, but now perhaps, at least in financial services, does not make sense, this distinction, in my opinion. We have a higher level, which is customers, and we have to protect customers rather than only consumers. Because now we add something because you are a consumer, but it is mainly regulated as a customer. This is just confusion in practice without a cost-benefit benefit for, a proportionate benefit for the market. It is an additional layer of complication without so many practical effects. Also, if I look at the interpretation of Unfair Commercial Practice Directive, at the end there is no distinction if who suffered the loss was a consumer or customer. In the practice, both at least in Italy, because it's a public authority empowered over the enforcement, the antitrust authority does not make this difference. And also when you are in front of the court, because you are suing against the decision of the authority, they don't make any reference if the behavior was addressed to consumer or customers. They look at the behavior and that's all. So at the end, in practice, also this distinction is not so relevant. There are additional rights, yes, you can withdraw for it, recess, okay, but it's a tribute because we have to apply this horizontal regulation.
Yes. Here in Poland, I think there is quite clear distinction between consumer and client, because the consumer is everybody who is a natural person, who is in the relation with the entrepreneur, and what he's doing is not in connection with his professional activity. And when we talk about the client is everybody. So we have the protection of consumer, and probably the most important sphere of this protection is protection against imposing the unfair contract terms. And we have client protection, which is protection referring the informative obligations and demanded needs test. First, when we took the banks and the insurance sector, for example, still in Poland, I think if we are talking about the insurance broker who is insuring his business, I'm not talking about liability insurance even. His natural person, let's imagine, he will be treated like a consumer because the law says so. If we talk, let's say, about some kind of a bank agent who is natural person, he won't be treated like a consumer because there is no such regulation when we talk about the banks. So the first question is whether the banks should be treated, in your opinion, completely equally, like insurance, or what kind of differences do we need? And the second question, this is what was Marcin mentioned, the client protection and the question whether the investor is a consumer. Yeah, let's say somebody who is investing money into some kind of investment scheme, and then of course, he's a huge entrepreneur generally, but he knows everything about the market, but he's investing his private money. So probably, additionally to the client protection here, which is information, which is demanded needs, additionally, there is a question of using the protection against imposing the unfair contract terms. For example, if you are, acquiring shares in a joint stock company, can you say that the charter of the joint stock company was unfair contract term? Do we need two separate levels of protection, one to client and second to consumer, or maybe we should unify them? Because additionally, to some person, apart from the question of information, apart of the question of the demand and needs, then he may say, well, but this is unfair contract terms. We should do something with it.
Thank you. Yes, in Poland, actually, we have a lot of discussion about consumer protection and how can we name a consumer And according to civil code, a consumer is a natural person who acts for purposes outside their trade, business, and so on. And the question is that really the reason to protect people, that they are buying something for their private purposes, or maybe the need for protection is going from something different? And in my opinion, people, not only consumers, people should be protected because there is so many asymmetries on the market. So there is information asymmetry, there is emotional asymmetry, there is affect asymmetry, knowledge and experience asymmetry. So there is no fair game on the market if there is so many asymmetries between parties. So asking about the consumer protection is not the point. We should protect people or even companies because of those asymmetries. And what I mean by protection, it is not saying that someone should be treated in some special way because it's a consumer. Protection is only leveling the level of market game. So it's not taking someone above. So if we speak about financial market, it doesn't mean, protection doesn't mean that we take consumer and take him higher than financial institutions. We try to make him or her on the same level as financial institutions. And that is the real reason for protection. Not only consumers, but everyone who is in worse position than experienced and experienced financial institutions with so many tools right now, additionally with artificial intelligence and so on. But we, as humans, we are emotional, we make decisions sometimes not rational, and it doesn't mean whether we act as a businessmen or just ordinary people, consumers. That's the difference. So that's why, in my opinion, everyone should be protected if there is asymmetry. Thank you.
Okay, last comment from Professor Maśniak.
Very short because I know about the time. I have the short question for the Pierpaolo Marano because Pierpaolo Marano will leave us after the break, and because he provides the workshop for students. But probably the discussion during the next panels will be concentrated on the supervision guidance. And so the question for you, what do you think about the supervision guidance, for example, the supervision recommendations from the legal point of view? What is your opinion? Is it the proper, adequate instrument for the main challenge, main goal of the supervision? What do you think?
So we have we have a long tradition in Italy of this, let's say, regulatory intervention rather than legislator, because our supervisory authority is also empowered to adopt regulations, which are the law. In addition, we have seen in the recent years that they are adopting soft law. Soft law in terms of letters to the market, or Q&A, or opinions, guidance, or at least surveys. So, in practice, what can I tell you? If we have cases in front of the administrative courts, because if there is a suit against this, there is an exclusive competence of the administrative courts, and there were a couple of cases where the opponent said, you cannot adopt this decision based on this rule, and the court said there is no decision because there is no rule, because in terms of administrative law there is not a rule, so there is not something you can go against. Okay, this is. However, if in legal terms this is not, there is not an enforcement, in practice the market is following this, let's say, soft law. First, because now there is a trend to fill through the soft law the general clauses. If you say honestly, fairly, and professionally in the accordance with the best interest of their customers, you know, I have seen that the new draft of this soft law is in accordance to fairness, in accordance to fairly, rather than best interest. This is what we expect from you. In practice, how does it work? The regulator is telling you we have to go here, okay? And we recommend you to make right. However, if you achieve this objective going left, at the end, the regulator says, okay, what I want, and you achieve this cap, okay? I recommend the right, but if you can demonstrate that going left is the same, it's okay. This is, in practice, how does it work? Sometimes what happens, I will give you a case. Broad oversight and governance. You know that these rules will apply for all the products after 2019. All the products designed or under a substantial modification. Okay? In a letter to the market, at the end, regulator said, having said that, broad oversight governance, you have to do this, I recommend you to do this. In case of products who are distributing, still distributing, but designed it before, you should apply broad oversight and governance, even though according to the principle of proportionality. In addition, I mentioned it in this letter to the market, mainly insurance-based investment products. By the way, I tell you that in accordance to the principle of proportionality, try to apply the same also to non-life. At the end, there is uncertainty in the market, of course, because we don't know exactly what we have to do. But we know that the trend is that the regulator wants us to do something. In terms of enforcement, the reaction of the market is, I will try to do something. I'm pretty sure they do not enforce me on that. However, I really don't want to have an inspector coming to the insurance undertaking to say something, okay? So at the end is, let's say, a moral suasion without a specific deadline, but at the end, they are telling you what you want to achieve. And I have to say that after a preliminary step, letter to the market, I invite you to do this. If after a number of years you don't do anything, you in terms of the market is silent, then there is the hard law, because they have the power to adopt a regulation. So at the end, this is a way to invite the market to go in a certain direction, giving you more or less a deadline, and I cannot say explicit message, but the idea is, okay, I don't punish you, okay, for the next couple of years, more or less. I give you the chance to, because, you know, you have to adopt a number of interventions. They are costly, so that you have to do something. But then, please, I don't want to see this. This is the approach based on my experience. And the Italian market has a huge experience in this because we have this double nature of our supervisory authority, which is also a regulator. And trust me, when I was involved in an issue with Luxembourg, and when I asked the colleagues, okay, I see the Luxembourg law, please give me the regulation adopted by the supervisory authority. And they say, we don't have a regulation. This is the law, is more or less copy-paste from the directives. You know, in Italy we have almost now in force 90 regulations adopted by hard law regulations adopted by the supervisory authority. And the number of articles is much higher than the civil codes, just to give you an idea of the level of complexity. The main issue is the golden plating, because there is a trend of some supervisory authority to introduce additional rules which are not strictly requested from the European Union. And the gold plating can be, it depends on the national law also, if they consider this as general good rules, can be a barrier to the competition. Because if I adopt this kind of regulation, and then I say that these rules must be observed by everybody carrying out business in Poland, including the insurers based outside of Poland, then you need to justify the reasons why, and perhaps it's challenging to say that a general good rule is a rule which is not hard law. Because I think it's an evident contradiction. If you have to protect a general good, how is it possible to protect with a soft law rather than a hard law? So that's the reason why you need to be, let's say, careful.
Thank you.
And this way we started the second session, but don't worry. The chair closes officially the session, and here comes the break. Welcome.